Joining me now, the CEO of ERShares, Joel Schulman. Joel, front page of the Wall Street Journal today, Wall Street's betting the Fed is bluffing in high-stakes inflation game. And that certainly seems to be part of the reason stocks started rallying in mid-June.
Right. Well, so they're up 20% from their lows, and we've seen some of the biggest growth coming in with the strongest appreciation from these high growth stocks. So we've seen a large shift from value to growth in the last month and a half, and we're seeing considerable volume. We've seen $12 billion flow into equities last week, most of it into growth stocks, and we're seeing the advanced decline line. Some people look at advanced decline volume as an indicator, way up over the last month and a half. We've seen significant 3 or 4 significant days where there was a huge amount of money flowing in. Now today's a little off. As you point out, all eyes are on next week's Jackson Hole event, Thursday, Friday, Saturday, and we have 3 rate hikes coming our way: September, November, and December. And the question is whether it's going to be 75, 50, or 25 basis points.
Where do you think that the Fed takes short-term interest rates? How high do they go? Because they're at 2.5% right now.
I see another 75 basis point hike next month in September. And then a lot of people think it's going to start to trail off in December to 25 basis points. And really the question is, how's the data looking with inflation? Is inflation starting to, continuing to make progress and coming down a little bit? And then, the November meeting, many people are predicting 25 basis points. Maybe it's 50. It would be, purely a guess. It's going to be the midpoint between the 75 and the 25 in September and December. So I'm predicting 50 basis points November. So we're going to continue to see rate hikes, and then we'll see through next year what happens.
So I'm wondering, Joel, what do you think in terms of recession and earnings growth next year, and how does that impact your view of the market?
I mean, we have to remember that unemployment is 2%, 2.1%. below historical levels. I mean, we've got a very strong economy here. And to your point, many of these companies continue to push earnings to record levels. We're seeing a number of companies up 40, 50, 60% or more in the last month because they beat on earnings surprises, and they continue to push the market. And some companies, particularly in tech and healthcare, are expanding margins. So they're growing revenues and expanding the margins. So we're seeing, I think, a relatively, I think there's a good shot at having a soft landing this year, primarily because the labor market's so strong. I mean, we've got rising energy, food, and costs, and this is certainly wreaking havoc on consumers. But many companies continue to do well, and they're having a hard time with employment. We are seeing some benefits related to green cards picking up. There are more green cards now. There's offshore hiring and so forth. That's having somewhat of a mitigating effect on the employment levels. But we've got to remember, this is a very hot economy when it comes to employment, and that's probably going to keep us moving along, for the next year, with relatively slow GDP growth.
But Joel, the unemployment is to quote Stephanie Pomboy, is the laggingest of indicators. And there's a new survey from PricewaterhouseCoopers that reveals layoffs are in the works at half of the 700 companies that they surveyed. This might help margins.
That's right.
You cut costs, it flows to the bottom line, but this comes after the July jobs report. It did come in better than expected. Jobless claims declined to 250,000 for the most recent week. But anecdotally, if you talk to people who are in charge of hiring at a lot of these major companies, at a bare minimum, there's a hiring freeze, and there's a lot of fat. There is a lot of fat to cut at these large technology companies. There are a lot of people sitting around not doing anything.
Yeah, no, you're absolutely right. It's the tech companies. In fact, we're seeing the nascent tech companies, those that are fairly young, that are not getting private equity financing anymore. They had very high valuations last year, and so we're seeing a lot of layoffs among some of the tech companies that have losses and they're not getting refinanced. So you're right. The unemployment levels will rise, and again at 3.5%, we're about 2.1, 2.2% below historical levels. So we've enjoyed very, very low unemployment levels the last 5-6 years, and that's probably going to be changing here in the next the next year or so. No question about it.
Joel, it's great to see you today.
Good seeing you. Thank you.
Thank you so much.